This week, President Joe Biden stumbled upon the best way to crash the stock market. Just threatened to take away investment profits by doubling the capital gains tax. So as the government is contemplating increasing their cut of the profit pie, companies are announcing price increases that have nothing to do with what the Federal Reserve is calling transitory inflation. But no need to worry about the dollar when we have digital currency on the way that will take away all the control and privacy of our own money. All that and more on today's Weekly Econ update. Let's get into it. This week started out slow in markets as Wall Street tried to find its direction after stunning growth over the last year. Not just that, Wall Street is trying to figure out what to do with central bank digital currencies that seem like they will be the way of the future. CNBC reported this week that Wall Street sees central bank digital currencies as the next big disruptive force on the horizon. The Federal Reserve has been cautious about moving towards a digital dollar and away from cash, but other countries, most notably China, have fully embraced it and are on the brink of a major rollout. Digital currencies are favored by some central banks because they have complete control over them and are able to monitor everyone's transactions. They can even control when the currency is spent, where, and set expiration dates on deposits into your digital wallet, forcing people to spend and stimulate the economy instead of saving. So if I'm understanding this correctly, I have to give up being able to hold this to have it all here, where I have virtually no control over it and the government tracking every penny that's spent. That sounds like a great trade-off for you and me. China's moves toward this digital financial frontier have led some to worry that it will be a threat to the US dollar. But according to recent reporting from the Wall Street Journal, we should take the word of the Chinese central bank that their digital currency isn't an effort to displace the dollar. If you believe that, then I guess we should just take the Federal Reserve at its word that they can defy all historical precedent and ramp up the money printing without causing any significant inflation. And speaking of price increases that the Federal Reserve says we shouldn't worry about happening, companies are announcing price increases that will be happening. This Tuesday, the Wall Street Journal reported that Procter & Gamble will be raising prices on a wide range of consumer goods in September. This comes on top of a similar announcement by rival producer Kimberly-Clark Corp, the maker of Huggies diapers, as well as other major manufacturers like General Mills, Hormel, and others. They cite rising commodity prices for their manufacturing inputs like pulp and resins, and higher expenses for transporting goods. Well, let's take a look at the producer price index and see if there's any truth to that. Here's the price index for wood pulp, up 18.7% over the last 12 months, plastic resin up 25.6% over the last 12 months, and freight and mail transportation up 5.1% over the last 12 months. So yeah, I think we have a problem with input prices for our manufacturing industry. The reason we haven't seen these increases in consumer prices is that there's a lag from when the manufacturer experiences higher input prices to when that gets passed through to the consumer, as we're seeing from the announced price increases from these major producers. This type of inflation is not the kind of inflation that the Federal Reserve says are from base effects and will be transitory. If you want to know more about the kind of inflation the Fed has been referring to, check out our recent video on the Consumer Price Index report released this month. Unfortunately, these manufacturing input price increases are above and beyond what the Fed says will come and go. Now, usually when the threat of inflation creeps up, the Federal Reserve is the one to take away the punch bowl from the party and rein in the money supply. Fed Chairman Powell has assured us that he won't be doing it this time, and for some reason, President Biden has decided to take on that role. On Thursday, reports of the Biden administration considering a nearly 100% increase in the capital gains tax rate started some worries on Wall Street, and stocks sold off in response. Reports stated that Biden planned to increase capital gains tax on those making over $1 million per year from the current 20% rate to 39.6% to pay for more multi-trillion-dollar spending plans. Such a tax increase would create a disincentive for investments and could impact future economic growth. The Biden administration doesn't seem too concerned about it, however, and on Friday brushed aside the drop in stocks the day before. But hey, why do you need private sector investment money when you can just print it and invest it for them? It's not like that kind of thing ever caused inflation in the past, right? Please give this video a thumbs up and subscribe to support our channel and help us grow. That's going to do it for us today, and thank you for joining us for this episode of the Weekly Econ Update. I'll see you in the next video.